It is almost October, and we're going to be doing some looking at our portfolios to deploy some capital. And Tyler and I are going to share a few stocks that we are looking at adding to in our portfolio. Before we do, please take a minute and check out the link you see on your screen for a message from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now, and it's the best way to support this work we're doing. So I'll start with one that I am thinking of adding to in my portfolio. I opened up a starter position in this one shortly after all the regional banking drama that was going on earlier this year, and it's Truist Financial. Ticker symbol is TFC. And the short version is that this is almost a mega bank that's being treated like a regional that could really run into serious issues. And it's still being priced like that. It's an interest rate sensitive stock because of its dividend, its consumer sensitivity, things like that. If interest rates go up, consumer demand and loan defaults can go up as well. So I get that. But Truist is a massive bank. It's technically a regional bank. Most of it's based in the southeast areas. And these are high growth markets. People really love Truist. Everyone I know who has an account at Truist tells me how good it is. It's a really solid run company. It's big enough that it is in that too big to fail category. It's a systemically important financial institution, or SIFI, and that subjects it to more regulatory scrutiny than the average bank. It pays a 7.3% dividend. Its numbers have looked very, very good lately. Its defaults aren't at any level I would be concerned with. And like I said, it's a regional bank that's big enough that it's almost a mega bank, but it's being treated as if it's in the same boat as a bank that's about 1/10 of its size. So I'm not worried about Truist going forward. I think that dividend is fantastic and safe. I love their management, and it's one that I am probably going to continue to add to that relatively small position I have. Tyler, you have two that you wanted to talk about. So what are you looking at?
Yeah, so I just wanted to mention because I just started looking up Truist's financials while you were talking about it, and there's not a lot of banks where you can get a price to book value at 0.7 times. So, like you were saying, it's pretty cheap for a bank, especially one that may not necessarily be the cannon fodder that is regional banks lately. But we're going to go into two sectors that I have been pretty excited about as an investor over the past couple of years, as home builders and oil and gas. So we're going to start with home builders. I think there's been a lot of chatter about why home builders are attractive right now. Berkshire Hathaway just bought three of the biggest ones. Uh, for I think of I don't want to speculate as to why. We've done that elsewhere, but you know new home build is going to be a huge thing over the next couple of years. It's going to be like the lifeblood of the housing sector because with higher interest rates, people don't want to move. And so you're not seeing a lot of existing home sales right now. I think new homes as a percentage of total sales typically was in the 10 to 14% range for the longest time. And right now it's ticking up into the 30% range. It is uncharted territory for new home sales in the United States. And because of that, that low supply, even though we have, high interest rates, which would say, hey, prices need to come down, supply is so low, prices are staying high. And so home builders' margins are still looking fantastic, even though people would say we're in a real housing lull lately. So one company I want to highlight, and it's one that I've followed for a while and one that interests me a lot, is Green Brick Partners. They're a kind of a niche specialty home builder, focuses a lot on the Sun Belt. Their biggest concentration is in Dallas. And one of the things that I like, two things that I like about them a lot. Number one, they're excellent underwriters of their new projects. I think a lot of people want to talk about the option land, buying land on option contracts rather than, developing it themselves. It's kind of been the hot thing in home builders to be asset light. Green Brick, they do their own development and they want to do it because they get to keep the margin when they develop their land. And, for what makes that attractive for them is because they're very good underwriters, meaning they're very conservative when they actually want to deploy capital into a new development rather than indiscriminately buying as much as they can and kind of getting into those land grab wars. When you're really good with your underwriting, it's okay to develop yourself, to take that margin because you're not leveraging yourself to things that may not work out if things start to go south. So they have that, and then they have a fantastic balance sheet. They have one of the best debt to capitals in the entire industry, despite it being considerably smaller than a lot of the other companies in this industry. So low debt, good underwriting. Management has had a real penchant for, if we have extra cash, we're going to return it to shareholders rather than, go out and buy a bunch of extra land and get marginal returns for it. So all of those things kind of lumped together. It's been one of the better performing businesses in the home builder industry, and I think it's going to continue doing that for those very reasons. And then let's go to oil and gas, and this is where it gets really funky, because that's really what I do when we go on these videos. Is I want to talk about an offshore oil rig company called Noble Corporation. If anybody who followed oil and gas, we had that huge crash 7, 8, 9 years ago with the kind of too much shale really tanked the market, and offshore oil rigs were hammered. Every company in this industry but one filed for Chapter 11 bankruptcy and had to kind of restructure their debt. But Noble was one of them, and it has reemerged from Chapter 11 bankruptcy with a very, very clean balance sheet and a very good fleet of rigs that are being put to work right now. It has a lot of work with ExxonMobil for a lot of ExxonMobil's offshore work in the country of Guyana, which is one of its biggest finds in the past, I think, in the 21st century. So it's got a lot of work there. It's working a lot in Brazil, and it's getting really good rates, and rates for offshore rigs are increasing. So every new contract that they're getting are looking more profitable. They're looking better than the previous one. And so you kind of bundle all that together. They don't have a lot of spending commitments over the next couple of years. So all excess cash is going to be thrown back to investors. They just initiated a new dividend. They've been buying back stock. I think this is a company that over the next couple of years is positioned to do extremely well in an oil and gas environment that is going to be, I think, constructive, meaning there's going to be a lot of new things. A lot of spending is going to be happening to make up for a lot of spending that we didn't do in the previous years. So for that reason, I think that Noble Corp is one of the more attractive oil and gas opportunities out there, and one that I really consider adding to my portfolio or adding to my existing position.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by nearly 4 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 504% as of September 8th, 2023, and are measured against the S&P 500 returns of 130% as of September 8th, 2023.